Energy stocks on the S&P 500 have delivered in a massive way. You all know that. We're up 35% year to date, even with a bit of weakness over the last week or so. JP Morgan is making the case to stick with energy names. They say the following: energy remains our highest conviction overweight. The supply-demand balance continues to be tilted in favour of improving demand with higher commodity prices. Supply growth should remain impaired. Saira, Malik, Haghbin back with us. Saira, I promised you would come back to this story. Can you just build on why you still like this part of the market?
Energy was our biggest overweight coming into 2022, and it was for three reasons, and that is tight supply, strong demand as the world reopens, and also the key to this cycle is producer discipline. Producers are focused on returning cash to shareholders. They're being much more disciplined in terms of capital spending. That leads us to an elongated energy cycle. We did not expect the tragic war in Russia and Ukraine and what that did to energy prices, but overall, we view this as a real cycle going forward, and we think energy stocks can continue to do well over multiple years.
Saira, is this for a basket of names across various geographies or more concentrated than that?
We like stocks from in the U.S. We also like the refiners like Valero. We think that's usually the lagging trade when oil prices start to go up because they start to benefit from what the producers are doing. So we see across the board. Also the companies that are providing the bridges to more green energy. We see it as a pretty broad trade.
Mo, do you agree?
I do, yeah. To my earlier points, I think we're very much still overweight cyclicals, and energy is a big part of that. And I think a lot of that move in energy, is really more on kind of the supply side and really what's happening with the war in Ukraine. But we also know as part of kind of this reopening theme that the demand side has been there. So we're still very constructive, and we're still very overweight on the energy side.
Mo, is there anything the Fed might do that would make you change your mind?
On energy specifically, probably not at this point. I think the dynamics that we're seeing play out across kind of energy markets, and it's not just some of the things we're seeing around the war in Ukraine, but just the supply side bottlenecks. I don't think the Fed in this case is going to impact that. What I'd be more concerned about is just some sort of compromise or some sort of jump risk associated with it, because we have moved quite a bit in energy prices, and I'm not sure the upside is equivalent to the downside at this point. So just being careful and kind of readjusting that position over time as the energy sector has run, I think would be prudent here.
Saira, what's more likely to change the energy story for you, the demand side or the supply side?
It'd likely be the demand side, and this would be the Fed becoming too aggressive with rate hikes. We're expecting 250 basis point rate hikes at the next two Fed meetings. And then what we're hoping is that they wait and see what that does to demand, and also whether inflation really did peak in March, because the path to a soft landing for the Fed is narrowing, but it is still our base case. But what they need to do is hopefully they'll become less aggressive with rate hikes as the year goes on. Otherwise, what you will get is demand destruction, and that will be a headwind for the energy story.
Saira, is that the mark on the calendar for you? Is that the spot that will really shape whether you think we get this soft landing or not? It's through the summer after those 250 basis point hikes. It's the what next of it after the Fed makes those moves.
Well, it's tough to see because when the Fed make moves, you don't really see the result for quite a few months. So it's going to be challenging for them to watch inflation and see how much does it moderate after the peak, and then how do they react to it. And that's where they'll have to either take their foot off the gas or up the ante. I think that is going to be challenging. Threading that needle and getting to that soft landing is going to be challenging. It does increase the risk of a recession going forward, but that's not our base case. Even with yields, we see them maxing out at about 3% this year, which we've already gotten to. So that's why we like growth stocks, because yields start to stay in a trading range from here. Economic growth moderates. That is good for those companies which are less levered to economic growth, like growth companies in technology and healthcare.
And just how much inflation is this Fed willing to tolerate as we come down from 8, 7, 6, 5, 4? Saira, Malik, Mo Haghbin, to the two of you, thank you very much.